Picture this. You open your trading screen, expecting another quiet day in the forgotten edges of the small cap universe. But before you even take a sip of your coffee, you are hit with something so violent and so out of scale that you almost doubt your own data feed. And before we go further, there is a trading strategy segment later in this video that reflects the real market conditions. So stay with me until the end. If you are watching on Shorts, use the full version link below so you can hear the trading strategy in the later section without interruptions. On November 24th, 2025, Inno Holdings Incorporated, with the ticker INHD, a microcap that usually moves like a drifting shadow, suddenly behaved like a live charge thrown onto the NASDAQ floor. The prior day it closed near $0.73. It opened around $0.94. It dipped to roughly $0.80, and then without warning, it rocketed upward in a near vertical burst to about $3.45. More than 200,000 shares traded in a single session. A normal microcap does not behave like this. Under typical conditions, a stock in this category trades lightly with modest liquidity. Spreads remain wide. Even a mid-sized order can jolt the price. But INHD did not follow any normal pattern that day. The only way a move of this scale happens is when the structure supporting the stock is already primed with mechanisms that magnify volatility. To understand how we arrived at this moment, we need to trace the story from the beginning. In 2019, Inno Holdings entered the construction technology world with a focus on cold-formed steel framing, a process where thin steel sheets are shaped at room temperature through roll-forming equipment. In standard manufacturing environments, this requires staff teams, sizable warehouses, dependable supply chains, and logistics networks that can feed contractors on schedule. But Inno Holdings attempted to do this with about 4 employees. Instead of growing traditionally, the company framed itself as a technology-driven disruptor, relying on lean operations. One of its core inventions was a mobile factory, which was essentially a compact roll-forming line built onto a trailer. The idea was that instead of producing steel framing components at a large plant, you could bring the factory to the job site and manufacture nearby. Along with this, the company also sold prefabricated housing modules and caster cubes and provided consulting and incorporation guidance. It was an unusual mix. It looked like a hybrid between industrial manufacturing and a startup services firm, and that mix required flawless execution to scale. Revenues remained small. By 2024, the company was making under $1 million annually, and by late 2025, its trailing revenue reached around $3 million. Losses grew toward about $6 million. In a typical early-stage industrial business, management would secure credit lines, strategic partners, or staggered growth cycles. But Inno Holdings instead relied on serial equity issuance, which means raising money repeatedly by creating and selling new shares. This practice is common among distressed microcaps when cash flow is scarce. This pattern began right after the $10 million IPO in December 2023, when INHD joined the NASDAQ capital market. Most IPO stage companies stabilize operations during their first year. Instead, Inno Holdings announced expansions. In March 2024, it shared plans for Texas plant automation. In December 2024, it announced a jump into electronic product trading and digital transformation services. Normally, companies expand into unrelated sectors only after proving profitability or at least predictable scaling. But INHD expanded outward before building a solid core. By late 2024, shares declined enough that management executed a 1-for-10 reverse split on October 8th, 2024. Reverse splits happen when a stock drops too close to the exchange minimum listing price. Combining shares lifts the price without changing company value. It is usually a sign of pressure, not strength. The year 2025 raised the stakes. Revenue rose slightly from around $2,000 early in the year to over $1,000 by mid-year, but net losses remained sizable. Technical indicators declined, RSI stayed oversold, MACD stayed negative, all moving averages tilted downward. These conditions usually lead to long phases of illiquidity and slow price decay. But this was not the path INHD was preparing. On July 4, 2025, the company filed an 8K revealing a standby equity purchase agreement. A SEPA lets a company sell new shares to a committed buyer on demand. Healthy mid-cap companies rarely use SEPAs because they have access to credit and bond markets. Microcaps use them when cash flow is unstable. Then, on August 11, 2025, At a special shareholder meeting, the company received approval for another reverse split between 1-for-5 and 1-for-25, and approval to issue up to 25,000 new shares. At the time, the company had under 8,000 shares outstanding. In ordinary governance practice, companies avoid authorizing share counts several times larger than their existing float because it signals severe dilution risk. INHD's request and approval were extraordinary and implied that heavy future equity issuance was expected. A spark arrived on August 25, 2025, when a report stated that retail traders who had recently fueled momentum in Opendoor and OfferPad were now cycling into INHD. Microcaps under normal conditions stay invisible to crowds, but when meme-driven trading focuses on a thin float, ticker volume can explode far beyond the float. INHD saw volume above 17,000 shares, a sign that the price action did not reflect fundamental discovery, but rather rotational speculation. Soon after, on September 10, 2025, the company announced a $7 million registered direct offering with shares and pre-funded warrants priced near $3.6. Registered direct offerings are used when companies need immediate capital and accept dilution. The deal closed on September 11, 2025. On September 16, 2025, management announced a partnership with Starlight Telecom targeting MEEA regions. Under normal circumstances, international expansion follows domestic scaling. Here it came right on the heels of dilutive financing, raising questions about timing and intent. Then came the critical turning point. On November 13, 2025, Inno Holdings announced a $50 million at-the-market equity offering program. An ATM allows companies to sell newly created shares directly into the market at current prices. Normally, ATMs are used sparingly and mainly by stable mid-cap or large-cap firms. But for INHD, which had a market cap near $15 million at the time, authorizing $50 million of potential share sales meant the company now had an issuance engine far larger than its market valuation. Which brings us back to November 24, 2025. Retail enthusiasm surged. The stock launched upward. But because the ATM and SEPA were active, the company could inject new shares directly into the frenzy. Normally, companies cannot create new shares intraday and sell them instantly because issuance mechanisms are too slow. But an ATM changes the dynamic. It creates a system where supply expands exactly when demand spikes. The result is engineered volatility. A dramatic surge powered by meme interest, followed by a sharp reversion caused by newly introduced supply. Volume explodes. Price snaps back. Retail traders are left trying to decode what just happened. For investors, the emotional impact is intense. The upward surge taps into the desire for asymmetric opportunity. But dilution risk sits beneath the surface like a pressure wave. It can reverse gains with no warning. It becomes difficult to tell whether you are seeing potential growth or the mechanics of a financing system reacting to liquidity. Throughout the timeline from 2019 to November 2025, INHD shows a dual character. It is a company with real technological ambition in cold-formed steel and mobile modular manufacturing, but it is also a company relying heavily on equity issuance to survive. This shapes its volatility, its valuation behavior, and the psychological journey of its investors. Thank you to the viewers who stay through the later segments of these videos, and to those who subscribe, like, comment, and even share the videos elsewhere. I appreciate every one of you and will repay your support with even better content. This was ValueStir.